Good morning, everyone. You are watching a live daily market outlook for Thursday, 27th of October 2011, prepared by Windsor Brokers. The long-awaited event, Eurozone summit regarding handling the Europeans' debt crisis is finally starting to materialize, as on yesterday's meeting the Eurozone leaders reached deal with the private banks and insurers to accept 50% loss on their Greek government bonds under a plan to lower Greeks' debt burden and try to contain the two-year-old Eurozone crisis. The agreement was reached after more than 8 hours of hard negotiations involving bankers, head of states, central bankers, and the IMF members. And it aims to draw a line under spiraling debt problems that have threatened to unravel the European single currency project, as the spreading of the crisis from Greece through the neighboring countries, as the Italy, as second biggest economy in Eurozone, is coming under threat with their debts estimated at around 1.9 trillion euros, and actually threatening the whole Eurozone to fall apart in case of contagion of the current debt. Also, under the deal, the private sector agreed to voluntarily accept a nominal 50% cut on its bond investments to reduce Greece's debt by 100 billion euros, and cutting its debt to 120% of GDP by year 2020 from current 160% of GDP. At the same time, the Eurozone will offer some sort of credit enhancements or sweeteners to the private sector totaling 30 billion euros. The aim is to complete negotiations on the package by the end of the year, so Greece will have a full second financial aid program in place before 2012 starts. The value of that package, according to EU sources, would be around 130 billion euros, up from initial 109 billion euros when the deal was last reached in July. The summit, as President Sarkozy said, the summit allowed us to adopt the components of a global response, of an ambitious response, of a credible response to the crisis that is sweeping across the Eurozone, as well as a deal on deeper private sector participation in Greece, which emerged after Sarkozy and the German Chancellor Merkel engaged in the negotiations with bankers. The Eurozone leaders also agreed to scale up a European Financial Stability Facility known as EFSF, their 440 billion euros bailout fund set up last year. The fund has already been used to provide help to Ireland, Portugal and Greece, and leaving around, for now, around 200 billion euros available. Around 250 billion of that will be leveraged 4 to 5 times, producing a headline figure of around 1 trillion euros, which will be deployed in a variety of ways. The lenders also hope that will be enough to stave off any worsening of the debt problems in Italy and Spain, the region's third and fourth largest economies respectively. As a result of this announcement of the deal, the riskier assets were higher across the board as stocks were rallying immediately after the announcement, and the euro and sterling recovered after yesterday's sharp dip just ahead of announcement of the result of the Eurozone summit. Also, precious metals and the energies benefited from the recent, from the yesterday's deal of Eurozone summit. Let's have a quick look on today's calendar. As expected, the overnight call rate by Bank of Japan remained unchanged at 0 to 0.10%, while Japanese retail sales improved from the previous minus 2.6 release. However, still much below the expectation at 0%, with today's release coming out at minus 1.2%. Also from New Zealand, the trade gap widened to $751 million compared to 697 million gap of the previous month, and 421 million forecasted for today. German preliminary CPI from the German states is due today and will be released during the day. From states, quarterly GDP is due at 12:30 GMT, with significant growth expected to 2.4% this time, and compared to the previous quarter at 1.3%, and weekly jobless claims from US at the same time expected slightly to decrease to 400,000 versus the 403,000 the previous week release. From at 1400 GMT, the pending home sales monthly release from states forecast for today raise of 0.2% versus the previous month contraction of minus 1.2%. Now let's take a look on the charts and see what was the recent reaction of the markets on the decision of Eurozone officials. As we can see, Euro is back to strength after 3 days consolidative 100 pips range, trading under previous high at 139.55. And yesterday's actually a sharp dip on investors hoping that there will be no exact deal, and trying to catch up the shorts before the others entered the market was actually short-lived, as the dip was contained at around 138, which is part of 138.00, 138.20, 138.00 support, initial support zone, ahead of quick recovery. Now break above 139.55 has already regained our initial barrier at 140, which is Fibonacci level, 61.8% of 145.48 down to 131.45, keeping the upside firmly in focus. Immediate barrier comes 140.47, which is 90 days moving average on daily, and then we have the strong one at 140.98, currently the 200 days simple moving average on the daily chart, above which to resume recovery and focus, actually to put aside the short medium-term bears from 145.48 and turn focus higher. Also significant is current break above the daily Ichimoku cloud that suggests that fresh bear bull face is opening, and further gains are seen into the levels of 142 initially. The similar picture with the cable, as the pair hit yesterday fresh high at 160.40, and the immediate reversal was contained at 159 zone, where also the main bull trend line drawn from 152.71 low stands, containing the dips, and quick reversal higher now is looking for test of 160.40. 160.34 was seen so far. However, clearance of 160.40 is required to open way for a test of 161.36, which is the 61.8 Fibonacci retracement, and then 200 days simple moving average. The short-term studies remain supportive for this rally, while initial support stands at 159.90, and the next level is 159.53, 159.53. Only loss of 159 support and the trend line would delay immediate bulls in favor of stronger correction, and would likely open strong support zone at 158.50, which is the previous consolidation range ceiling, and then comes 156.80 and 156.30. This is on a break below 159. Dollar yen holds the negative tone as marginal break below previous low at 75.73, hit a new one at 75.70 ahead of a quick recovery that was capped at 76.30. So the upside for now remains capped as a series of lower highs keep the focus to the downside. Unless intervention occurs, intervention by Bank of Japan, then we can expect further weakness as the pair currently holds below 76 level with immediate focus at 75.70, yesterday's fresh record low, and possible test of 75 next level, even to break lower, not ruled out at this stage. Negative studies remain supportive, keep pressure on the dollar yen and keep the downside favored. On the upside, break of 76.30, 76.50 would signal further recovery, as these are the initial barriers. However, clearance of 76.80, which is the main trend line resistance, and then 77 is to provide some near-term relief. However, clearance of 78 barrier on the wider picture would signal bottoming at 75.70 and the possible fresh development higher. In case of intervention, we might expect at least 300 pips bounce higher, and that would definitely confirm the near-term bottom and look for a further recovery. However, the longer-term outlook on dollar yen on the long term also remains firmly bearish for now. Dollar Swiss is at the back foot again after yesterday's break below 200 days moving average at 87.40 and extending down to 87.27, posting fresh low at 87.27. Subsequent bounce again was capped at 88.57, just ahead of our initial resistance at 88.80. And holding below this keeps the focus to the downside. Currently the pair is back under 80. Pair is back under 88 support and extending to 87.33. So basically retesting the previous low, below which would open way for a test of 86.46, which is the 15th of September low seen on the daily chart. Ahead of this, we have the 38.2 Fibonacci retracement at 86.96, and then 86.46 is our next target on the downside, 15th of September low. To avert immediate downside risk, a minimum of 88.89 level is required to be cleared to turn the near-term focus higher. Until then, the firm short-term downtrend is still intact. The crude oil is currently trading in the corrective mode after yesterday's, after hitting a high at 94.58 on the 25th, so day before yesterday, with the extension lower so far, retracing approximately, actually 23%, 23.6% of the recent uplift from 74.94 up to 94.58, where the temporary support was found. The near-term outlook and studies are still supportive, as seen on the hourly chart. However, losing momentum at this point might signal some stronger correction lower. With the 89 that was the low of yesterday, also close to previous about 90 actually, pardon. The 90, 89, 99 and 89.66 offering initial strong support ahead of levels at 84.20 and 83.37, which are the key short-term supports. On the upside, 50% Fibonacci retracement and the 200 days moving average at 94.85 are currently capping the near-term price action. Would break here to signal further extension up and probably focus our key barrier of $100 per barrel and 100.60 the last time traded on 26th of July this year. Gold has benefited after yesterday's announcement. Actually, before the announcement, the positive sentiment turned for the yellow metal, extending gains above previous highs at 1695 and 1700, then extending so far to 1727, which marks a near slightly above 50% Fibonacci retracement of the broader downtrend from 1920 down to 1532. With the daily studies still in the negative field and needed further extension higher to confirm the recovery. Immediate barrier on the upside 1743, which is the 55 days moving average, above which to open the Fibonacci retracement on at 1769, 61.8%. However, the current pullback as the 4-hour studies are in deep overbought zone would target on the downside the levels around 1700, 1695 before the bulls reassert, and actually ideally reversal should occur above 1700 in order to keep the immediate positive structure in play. Otherwise, a deeper reversal into 1650 is not ruled out, while loss of 1600 would definitely turn the focus to the downside.